Hello friends, Chris Lee, CPA here, back with another video for you. So today we're going to talk about self-directed IRAs. They're something that get a lot of attention in the right areas, in the right spaces of social media, and they deserve their attention. People will ask about them sometimes, and I feel like I'm always giving some amount of education that is kind of missed in the social media sphere. So we're gonna hit some of those points today. So when it comes to IRAs, individual retirement accounts, they can come in two primary ways for tax advantage purposes, and then there are two ways, and then within that sphere, there from a tax perspective, there are two flavors they come in generally, and then from an asset selection, what can actually be in an IRA, there are kind of two flavors of it. So as we all know, IRAs, individual retirement accounts, can come in tax deferred, which functions like a 401k, which is a traditional IRA. You get a deduction on the money going in. Those assets are invested, they grow, and then when you take the funds out after you reach age 59 and a half, then those become taxable to you personally. And then there's the Roth account, the Roth IRA. When you put the funds in, there's no tax deduction, no current tax benefit. The funds are invested and they grow and compound over time through those investment vehicles that are chosen in the account. And then when you take the funds out, there is, they come out without a tax consequence. But if they're drawn out after 59 and a half. The interesting thing on the Roth IRA is that the principal contributions, what you put into it, can be taken out at can oftentimes be taken out without penalty, but the earnings are going to be subject to penalty if withdrawn early. So that's one thing that you'll see sometimes in financial spaces. People talk about using your Roth IRA as your emergency fund. Not recommended, because it's much more likely to be subject to market fluctuations, and your emergency fund should really be a set amount of cash that you can take at any time that you would need it, 3 to 6 months expenses minimum. Anyway, now when it comes to either types of those accounts, whether traditional or IRA, the types of assets that can be inside the account can be similar and different. So you can have those accounts that are set up and managed by a traditional bank or brokerage house or trust company, in which case you're really going to be limited to a narrow range of investment options, such as publicly traded stocks, bonds, mutual funds, ETFs, and CDs. They typically aren't going to have alternative investments that would be like real estate or precious metals or cryptocurrency. So when it comes to those types of assets, you can hold them indirectly through mutual funds, certain ETFs, and that sort of thing. But if you're wanting a direct investment in those items, traditional brokerage firms are not going to be able to support that. However, the alternative to that, and this is where we can get creative with the asset inside a self-directed IRA, inside an IRA, is using a self-directed IRA. So this has fewer custodian imposed. A custodian is just to say who holds the account. There are fewer restrictions, so you get the option to look at other assets. So that can be direct investment in real estate, whether domestic or abroad. It can be private businesses. It can be tax lien investments, trust deeds and mortgages, direct investment in precious metals, private offerings, private equity and hedge funds, private placement, life insurance contracts, franchises, foreclosures, crowdfunding, crypto, farmland. Like, it can be really, it runs the gamut. So the same rules do still apply. If you take the money out before 59 and a half, and you're going to oftentimes be subject to a 10% penalty. Then again, self-directed IRAs can come in both flavors of traditional or Roth. Now, they're more complex to administer than traditional IRAs, and there can be some landmines hiding underneath them. So when it comes to a self-directed IRA, opening one is really finding a custodian that supports a self-directed IRA, signing the agreement and opening the account. From there, you can roll over your funds from a traditional from a typical IRA custodian to the self-directed IRA custodian. And then the fees for that can vary when it comes to, opening that self-directed IRA. Be flat fee, per asset fee, percentage-based fee of the account value, or some combination. And then when it comes to self-directed IRAs, there are two ways to do it. There's custodial self-directed IRAs and checkbook self-directed IRAs. So with custodial self-directed IRAs, the IRA custodian who's holding the account handles all the IRA's funds and assets. All transactions go through the custodian. And you're based in the custodian approves, execute, and funds the transaction. You're just directing the IRA to do such thing. With a checkbook self-directed IRA, which is, I'd say, maybe what you see is more common, the IRA it makes one single investment directly to purchase 100% interest in an LLC that is managed by you, the beneficiary of the account. So the IRA's LLC then purchases the investment. So the LLC may own any number of assets and have its own checking account, which you control. So you control what the LLC invests with. The steps to do this really, it's quite a long list, but essentially you form a manager-managed LLC in your state. So manager-managed means that it's not, so the LLC operating agreement says you can appoint someone to manage the LLC. It doesn't have to be the member. So you can have a member-managed LLC or a manager-managed. Member-managed is to say that you're going to have the entity that owns the LLC must manage it. But in this case, we're using a self-directed IRA to own the LLC, and it's owning it in a disregarded manner. So disregarded is to say that the LLC itself is not being taxed. It's taxed in the same way that is the member. So it flows through to the member functionally. And so it's being taxed like an IRA. So we can talk a little bit about the tax consequences of that in a little bit. So you form a manager-managed LLC that appoints you to serve as the manager LLC. You or any other person you choose. Oftentimes people doing self-directed IRAs are doing this because of the control of the investments that they want. From there, the LLC is going to set up a business checking account in the LLC's name. So you form the LLC, you'll then establish your self-directed IRA account with a custodian. You fund the self-directed IRA account with usually rollover dollars from either, from some other custodian IRA or 401k, or you'll use some initial contribution up to the annual limits to fund that account. Then once the self-directed IRA is funded, you'll direct this self-directed IRA custodian to invest your IRA funds into the LLC that is owned and serves as the single member of the LLC. So the IRA is going to invest into the LLC and be the single sole member of the LLC, where you control as manager the bank accounts. Then you'll use the LLC to fund investments and purchase assets within the LLC that are named to the LLC. So that is to say, you use the LLC and that disregarded tax attribute to be able to funnel, to kind of put it as kind of a subsidiary of the IRA account that more easily lets you access the funds to manage the funds. You should not use the funds for prohibited transactions. And so that's functionally what we're using that LLC for, is to more easily manage the LLC, not to do any prohibited transactions, which we'll talk about in a minute. So when it comes to the self-directed IRA LLC structure, it's possible that the LLC could have unrelated business income that's subject to tax, and so that would lead to a tax filing potentially. It's called a Form 990T, which is you'll see those if you've ever been in like nonprofit world, but they're a little bit of a nuanced thing to work through, I will say. what's important to know is that when you do the checkbook self-directed IRA, your custodian has no involvement with purchasing or administering investments for the IRA. The custodian doesn't need to sign any purchase agreements or disperse funds. Your LLC handles and purchases and disbursements and management of the assets by the LLC as managed by you. So that is to say, if the self-directed IRA LLC purchases a rental property, the LLC deposits the tenant's rents into the LLC bank account. The LLC uses its funds from its bank account to pay property taxes, insurance premiums, utility bills, property repairs, maintenance, all those sorts of things. So as manager of the LLC, you might become a landlord, functionally, indirectly a landlord, and have to deal with all those consequences, unless you use, obviously, a property management group or something like that. So that's by by hire. So a self-directed IRA does require more work on your part than a traditional IRA, and it's also going to involve more risk. As you go from a diversified portfolio that you might have at a brokerage or a traditional custodian where it's mostly just like large index funds / ETFs, self-directed custodian, like you're going to have the self-directed IRA custodians don't offer investments or provide investment advice. You're really, going on and buying assets, single assets rather than a diversified portfolio or a fund that represents a diversified portfolio. So you're basically on your own at this point when you get into a self-directed IRA, and so your risk profile goes up. So when you're doing a self-directed IRA, you really need to understand that if you're going from a balanced portfolio to a more concentrated portfolio, your risk profile changes pretty dramatically. So you need to look at whether or not these IRA funds that you're using to be higher risk are outbalancing your portfolio in a way that you're uncomfortable with. Obviously, everyone has a different risk profile, and if you're more accepting of that risk, then that's totally fine. But it's worth understanding that your risk profile from an investment strategy goes up very significantly. So it's up to you to decide what to invest in and conduct due diligence on the investments and that sort of thing. So when it comes to investing in alternative assets, it's riskier than stocks, bonds, and mutual funds. The rewards can be greater, but it could also be, a substantial hit in ways that are with traditional assets that are kind of being observed by the government and monitored overall with the economy. So when it comes to alternative investments, you need to know what you're doing and have it, maybe even an investment professional working with you. So the biggest problem when it comes to self-directed IRAs is prohibited transactions. So there are very strict rules that bar self-dealing and other prohibited transactions with your self-directed IRA. A self-directed IRA is not early penalty-free access to your retirement funds, and this is represented with what is considered a prohibited transaction. So if you violate these rules, they're pretty punitive, I would say. So unlike the self-directed IRA, when you have a traditional IRA, you don't need to worry about inadvertently violating the rules because your custodian generally alerts you or even prevents you from violating them. So that's part of what you're getting out of that. When you're in a self-directed IRA, it's just you, so you have to know the rules. So the prohibited transaction rules don't restrict what your self-directed IRA can invest in. Rather, the rules bar your self-directed IRA from transaction with a disqualified person, which can include you as the beneficiary, your spouse, lineal descendants, ascendants, or their spouses. So lineal descendants beneath you, lineal ascendants, which are people above you in your family chain, and then the spouses of those people. You benefit with another beneficiary of the IRA, say it's been, contingent beneficiary. So investment advisors and managers are also disqualified persons. Any corporation, partnership, or estate that you have at least 50% stake in. So if you have a minority interest in it, like that can be fine. And another disqualified person is your trustee, custodian, or anyone providing services in the IRA. So prohibited transactions include sale, exchange, or leasing property between your IRA and a disqualified person, extending credit or financing or other loans between your IRA or a disqualified person, or furnishing goods, services, or facilities between your IRA and a disqualified person. So any interaction between a disqualified person and your IRA, whether directly or indirectly, is often going to be problematic. So neither you nor the other disqualified person can borrow money from a self-directed IRA, sell property to it, use it for security on a loan, or buy property for personal use with self-directed IRA funds. And this personal use property gets into even vacation properties. So say you're buying a short-term rental, on the coast that you're looking to rent out, but then you might choose to stay in it according to your, that's a very strictly prohibited transaction. So if you're looking to do a vacation home, the self-directed IRA, a short-term vacation rental that you might have some amount of personal use with, the self-directed IRA is not the tool for it. So your self-directed IRA cannot purchase a rental property that you personally own from you, so you can't buy it from yourself. You can't buy a home that you lease to your child. You can't purchase a vacation home as a rental property or Airbnb that you or other family members use personally for 1 day or more per year. So like 1 day is considered disqualified. You cannot pay yourself a salary from a business that your self-directed IRA has invested in. You can't purchase a business more than 50% owned by you or your family, buy property or lease it to a company which you own over 50%, or hire a repair person for the rental property owned by the separate self-directed IRA. So a family member cannot serve as a disqualified person, can't even be hired to do a repair on the rental property. Like all of these are considered prohibited transactions and will blow up your self-directed IRA. So if your self-directed IRA engages in a prohibited transaction, it can lose its tax favored status as an IRA. And if that happens, then the code treats that as failed IRA, as if it had distributed all of its assets to you, the owner, at the fair market value on the first day of the year in which the prohibited transaction occurred. So it's not the end of the year, it's the first of the year. And so it's like everything was distributed all at once, which bumps your tax rate up crazy high. And then you're also going to have the, you'll have a penalty attached to that. So it's really not ideal. So taxes on self-directed IRA income is something that people don't often know either. So there are two types of taxes that occur. So there's unrelated business income tax, and then there's the unrelated debt financed income tax. So this is, when it comes to these two types of taxes, you're generally topping out at the 37% tax rate at around $15,000 because it gets taxed like at trust tax rates. So that's what you'll see kind of happening there when a IRA is subject to tax. So a self-directed IRA that earns $1,000 or more of gross income from an unrelated business will file 990T with the IRS and pay the UBIT. So investment income from passive investments don't create UBIT, and so passive investments be like real estate rental income, interest income, capital gain income, dividend income, royalty income. Those are considered passive. Basically, if your self-directed IRA gets K1 with ordinary income on it, that's where you're looking at UBIT consequences. So if that's to say, if you get it from a partnership, you're not a self-directed IRA is a prohibited shareholder of an S corp. So like you're not going to get the K1 from an S corp because your self-directed IRA isn't a qualified shareholder for S corporation purposes, but it could get a partnership K1. And so if you're getting a K1 from a partnership and it's an ordinary income producing business, that can create UBIT for your self-directed IRA. If the business is a C corporation, there's not that your self-directed IRA is invested in, there's not going to be any UBIT because the corporation pays corporate tax on its profits. and then it kicks out a dividend. And the dividend is what would become taxable. Or, well, the dividend is the income to the trust. It's not anything related to the corporation other than, it's not the corporate profits taxable to the self-directed IRA. It's just the dividends, and dividends are passive and not subject to UBIT. So that's actually what you get on the UBIT side, which again, UBIT is unrelated business income tax. Then there's the unrelated debt financed income tax. So this is a form of UBIT, but it's basically due when a self-directed IRA uses financing to acquire property. So it's paid on any income derived from such debt. So if your self-directed IRA buys a rental property worth $100,000 with 25% of non-recourse financing, 25% of the net income from that property is subject to unrelated debt financed income tax. So if the net income is $10,000, $2,500 would be subject to this unrelated debt financed income tax. And because of the debt, the IRA also must pay the tax when it sells the property. So part of the gain would also be subject to tax. The IRA can avoid the taxes by not using debt financing. So that requires that you've got enough capital within the self-directed IRA to not need the financing. So anyway, that pretty well covers it. But just remember the 5 takeaways here. You've got your, when you have an IRA, you're permitted to invest in anything other than collectibles and life insurance and an S corporation. The S corporation rule isn't related to IRAs. It's related to what is considered a qualified S corporation, which limits the types of shareholders. And so a self-directed IRA, an IRA in general is not permitted for as a qualified shareholder. But getting back to the main point, when you have an IRA, you are permitted to invest in anything functionally other than collectibles and certain life insurance contracts. So custodians for traditional IRAs typically limit your investments to for traditional IRAs, you're limited to publicly traded securities like stocks, bonds, mutual funds, ETFs, and CDs. But you can use a custodian that allows self-directed investments. You can use your IRA to invest in real estate, crypto, private offerings, and other alternative investments. So 2 types of IRA, self-directed IRAs. There's the custodian managed, the custodial self-directed IRA, where the custodian handles all the transactions. And then there's the checkbook, which is basically a self-directed IRA that owns an LLC, and that LLC does all of its investing, and the LLC is managed by you, and you manage the LLC and control the checkbook for the LLC. It gives you near total control over the self-directed IRA, which makes your which the primary issue there is, prohibited transactions with your IRA. If you violate the prohibited transaction rules, which can be complex, your IRA can lose its tax advantage status and incur meaningful and oftentimes punitive tax consequences for those prohibited transactions. And this includes any transaction between you and your close or not even that close relatives with your IRA. So prohibited transactions really can be problematic. So in some cases, self-directed IRAs do pay unrelated business income taxes. So this usually occurs when there's debt financing to purchase real estate, or if it owns an interest in an active trade or business that's sending out a K1. So those hit the main points and the key takeaways to know when it comes to self-directed IRAs. So there are definitely lots of options, especially if alternative investments are something you're interested in and interested in using IRA funds. All of this is to say, though, just understand that self-directed IRAs represent a major shift in your, most of the time, they represent a major shift in your risk profile within your portfolio, and it depends on the magnitude of the capital that's within that's going to be or is in the self-directed IRA relative to all the investable assets that you have. So the bigger chunk that the self-directed IRA represents of your total investable assets, the more significant the shift in your risk profile. So that's like a really important thing to be aware of. when people are asking me, and this is because I'm an accountant and more risk averse than others, but when people are asking about self-directed IRAs, I generally will ask what is their risk capacity. So when it comes to risk, there are a couple of things to think about. There's your willingness to take on risk, and then there's your risk capacity. And risk capacity is to say, how much risk can I assume such that if this were to go belly up, that like I'm okay still. So usually I'll follow up with questions asking about their risk capacity. And then we go from there. But anyway, that's about self-directed IRAs. If you've got any, specific tax questions you want to walk through or any ideas, you can feel free to connect in the link at the bottom of the video. I look forward to connecting with you. Take care. New video soon.